The ICT Silver Bullet is a 3-hour window inside the New York session where institutions deliver the highest probability setups of the trading day. Most traders miss it completely because they are looking for signals all day. The Silver Bullet teaches you to wait. The window runs from 10 a.m. to noon Eastern, right after the New York Open volatility fades, and the smart money consolidation liquidity grab is complete. Here is what you are watching for inside that window. First, price sweeps the sell-side liquidity below a prior swing low. This is the stop hunt. Retail shorts are liquidated. Retail longs have their stops triggered. Institutions are buying here. The fast reversal off the sweep creates a fair value gap on the way up. A 3-candle imbalance where the institutional buy orders left a footprint in the chart. That FVG becomes your entry zone. You do not chase the move. You wait for the pullback. Price returns to fill the FVG. That is your entry. You enter inside the FVG with your stop below the FVG low. First target is the swing high above the sweep. Second target, the buy-side liquidity pool above previous highs. 3 rules for a valid silver bullet. 1. Only trade this window between 10 and noon Eastern. Outside this window, it is not a silver bullet, it is noise. 2. The sweep must happen first. No sweep, no setup. If price has not taken liquidity, there is no entry. 3. FVG must form during the window. An FVG from the Asia session does not count. The imbalance must be fresh, created by the sweep reversal. Our bot detects silver bullet setups automatically. Sweep detection, FVG mapping, and time-gated entries all built in. Join the waitlist at smartinggoods.com/trading. CISD stands for Change in State of Delivery, one of ICT's most precise entry signals. It describes the exact moment when institutional order flow flips direction and gives you a rules-based way to trade the reversal. Here is what state of delivery means. Price was delivering bearishly, candle after candle making lower lows, closing in the lower half of the range. Institutions are distributing. This is the bearish state of delivery. Then one specific candle flips the delivery. It opens in the lower half of the range, but closes strongly in the upper half. A bullish engulfing momentum candle that absorbs all the prior selling. That candle is the CISD. The state of delivery has changed. That candle becomes the order block. Price never delivered from that zone as a seller. It flipped to a buyer. When price returns to that candle zone, it is returning to the exact origin of the institutional buy. This is your entry. You enter long inside the CISD order block. Stop goes below the CISD candle low. If price goes there, the delivery has not changed. You were wrong. First target the swing high from the prior move. Second target the buy-side liquidity above previous highs. 3 rules for a valid CISD entry. 1. CISD candle must close strongly opposite to the prior delivery. At least 50% of the candle must close above the midpoint. No weak closes. A strong close shows conviction. 2. Must break at least one prior swing. The CISD candle alone is not enough. Price needs to follow through and break the nearest swing high to confirm the delivery has truly shifted. 3. Enter on the retest, not the CISD candle itself. Wait for price to pull back into the CISD order block. Chasing the CISD candle puts your stop too far away and destroys your risk-reward. Our algorithm detects CISD events in real time. It identifies delivery flips, validates swing breaks, and maps the order block for precise retest entries. Join the waitlist at smartinggoods.com/trading. Cameron's model is a complete day trading framework built on 3 ICT pillars: daily bias, a liquidity sweep, and a kill zone entry. It ties everything together into a repeatable process that serious ICT traders use every single day. Step 1. Daily bias. Before you open a chart at the New York Open, you determine the direction for the day. Daily bias tells you which direction institutions are likely to deliver price. The bias is set by analyzing the higher time frame. If price is trading below a key level, bullish bias, you are looking for longs today. If price is above a key level, bearish bias, you are looking for shorts. Step 2. Wait for the kill zone. London or New York kill zone opens. You do not touch a trade before this. The kill zone is when institutions are active and ready to deliver price to the daily objective. Step 3. The liquidity grab. Inside the kill zone, price sweeps the liquidity opposite to your bias. Bullish day? Price sweeps down into sell-side liquidity first. This is the manipulation phase. An order block forms in the sweep zone. A fair value gap is created by the reversal move above. Step 4. Entry. Enter at the OB or FVG confluence. Price returning to the institutional footprint. Stop below the order block. First target the draw on liquidity. The first significant buy-side pool above. Second target the daily objective, where the daily bias predicted price would go. 3 rules to apply Cameron's model correctly. 1. Establish daily bias before the session opens. This cannot be done in real time during the move. You need to know your direction going in. 2. Only trade in the direction of bias. A bullish bias day is not a day to look for shorts, no matter how bearish a setup looks on a lower time frame. Stay aligned with institutions. 3. Kill zone entry after the liquidity sweep. No sweep, no trade. The sweep is what proves institutions were active. Without it, you are just guessing at direction. Our platform reads daily bias automatically and alerts you when Cameron's model conditions are met. Bias set, kill zone open, sweep detected. Join the waitlist at smartinggoods.com trading. Every fair value gap is a magnet. Price always returns to fill the imbalance. But what happens when price fills the gap and keeps going? That is the Inversion FVG, and it is one of the most powerful signals in ICT trading. Here is how it works. A bullish FVG forms during an upward move. The 3-candle imbalance that acts as support. Price comes back, fills the gap, bounces. Normal behavior. The FVG did its job. But sometimes price returns and fills the gap, then keeps dropping right through it. This is the inversion signal. Price does not stop at the fill, it breaks through. When that happens, the FVG inverts. The former support zone is now resistance. Institutions who were long have exited. The zone that attracted buyers is now attracting sellers. You want to be on the right side of this flip. The trade is simple. Price breaks below the bullish FVG, then retests the underside of that same zone, now acting as resistance. You enter the short at the retest of the inverted FVG. Stop above the inversion zone. First target is the swing low below. Second target, the sell side liquidity pool further down. 3 rules for a valid inversion FVG. 1. The FVG must be tested then broken. A clean fill followed by a clear break through the bottom of the zone. 2. A chalk or BOS must confirm the flip. Market structure must agree with the inversion. You need a directional shift, not just price touching the zone. 3. Enter only on the retest, not the break. The break gives the signal. The retest gives you the entry. Chasing the break puts you in at the worst possible price. Our bot tracks every FVG inversion in real time. It detects fills, breaks, and retest entries across all sessions automatically. Join the waitlist at smartinggoods.com/trading. Turtle soup is a liquidity trap, one of the cleanest reversal patterns in ICT trading. It is named after the original turtle trading system because this setup is specifically designed to trap turtle traders and other breakout traders who chase new lows. Here is how it works. Price forms an obvious swing low that every retail trader sees. Breakout traders place buy stops above and sell stops below this level. That cluster of stop orders becomes a sell-side liquidity pool sitting below the prior low. Institutions know it is there. At the setup, price breaks below the swing low, triggering all those stop-loss orders. Retail traders get stopped out of their longs. New short sellers jump in thinking a breakdown is happening, but then price closes back above the prior low on the same candle or the next one. The wick swept the liquidity. The short sellers are now trapped. Institutions have bought the lows, and price is about to reverse hard. The trade, you enter long above the prior low after the sweep candle confirms the close back above. Stop goes below the sweep low. First target is the opposing swing high, the buy-side side of the range. Second target, the buy-side liquidity above previous highs. 3 rules for a clean turtle soup. 1. Prior low must be obvious and clean. The more obvious the level, the more stop orders sitting there, the bigger the snapback. 2. Sweep candle must close back above the prior low. A wick below is not enough on its own. You need the candle body to reject the break. 3. Enter on the candle close, not the wick. The close confirms the trap has triggered. Entering mid-wick means you might be entering during the sweep itself. Our bot flags turtle soup setups in real time. It identifies prior liquidity pools, detects sweeps, and times entries to the close confirmation. Join the waitlist at smartinggoods.com. Start trading. Candle range theory teaches you to trade using the structure of individual candles as your map. Every candle tells a story about where institutions place liquidity, and CRT gives you a framework to read it. Here is the core concept. Every candle has a range, the distance between its high and its low. ICT teaches that the high is buy-side liquidity. Retail longs have their stops above highs. The low is sell-side liquidity. Retail shorts have their stops below lows. These stops are what institutions need to fill their orders. The CRT setup works like this. You identify a key candle, typically a 4-hour or 1-hour candle with a clean, defined range. Then you watch what happens at the boundaries. Price spikes above the candle high, breaking the range to the upside. That spike sweeps the buy-side liquidity. Retail breakout buyers get filled at the worst price. Institutions get the counter side of that trade at the top. Then price reverses and returns back inside the candle range. You enter short when price returns into the range after the high sweep, with your stop above the sweep high. First target is the candle low, the sell-side liquidity on the opposite side of the range. Second target, the sell-side liquidity pool below previous swing lows. 3 rules for a valid CRT. 1. Use a higher time frame candle. 4-hour or 1-hour candles give you the cleanest liquidity pools. Smaller candles create noise. 2. Sweep must close back inside the range. The spike candle needs to close back inside the prior candle's range. If it closes outside, the breakout is real, and this is not a CRT setup. 3. Target the opposite side of the range. The entire premise of CRT is that price sweeps one side and delivers to the other. High sweep targets the low, low sweep targets the high. Our bot applies CRT to every session. It detects 4-hour candle sweeps, range re-entries, and sets entries and targets automatically. Join the waitlist at smartinggoods.com. Trading.